the markets are getting more consolidated together. Everybody's, it's supposed to run independently, especially in commodities. But that's not what we're seeing. We're seeing wads of money show up and just buy certain sectors of the commodity markets and then leave.
Welcome to Hedge Heads, where hosts John Prischmann and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, it appears the fishing season is over here, at least for open water.
The boat is put away and winter's come.
It's downright chilly outside. I think it was single digits this morning when I got up.
I've shoveled at the office 3 times so far, and that is 2 more times than we had to shovel last year.
Well,
the entire winter.
Had to shovel versus you actually went out and shoveled are 2 separate things.
I get shamed into shoveling. Everybody around us has very timely shoveling, and then everyone makes a note about my shoveling, and I'm shamed into shoveling. But it works. I go out and shovel then.
That's true.
And every once in a while, the new guys that they hire for shoveling don't know that they're not supposed to shovel mine, and I get some free shoveling every once in a while.
That is a benefit of having good neighbors.
Yes, it's a very Fergus thing for me to like that.
Very true. That has nothing to do with commodities, so maybe we should talk about the hot market of cattle.
Yes.
Lately, what's going on with cattle?
The Mexican screwworm was the word on Monday, and it opened in spectacular fashion and then failed immediately. That's the definition of headline trading news. We had cattle on feed on Friday, and that is the government report, and there was slightly more cattle around. I think 100% of last year. They're expecting 99.9, so 0.1 off. And then the big surprise was higher placement. So the cattle market's been interesting because now you have the screwworm story. And then if you look at what they're saying about it, they said the United States and Mexico are working on implementing measures to resume the normal flow of Mexican exports, which that's the statement they've made, and it tells you nothing. And that's the way you've seen the markets trade. They've gone straight up, and then they've basically failed for 2 days in a row. And you have the investors are heavily invested in the meat complex, hogs, cattle, feeder cattle. At the same time, there's all this feed around. So what do you do if you have feed on the farm? You find an animal that you can go stick this feed into, and you bid them up at the sale barn with reckless abandon. And that's exactly what's happening right now. Just any price in the sale barn is the right price. And you hear these stories coming in, and then you get guys calling, and they get caught up in it. And this one's different. This is going to be the one that keeps going. And you hear this talk, and in my mind, that is exactly when you should start looking at hedging. So I'm officially making some recommendations for hedging for my clients, but we're doing a lot of different things in a lot of different markets. And that's not a blanket statement to go short cattle by any stretch. Most of it's going to be in options because of the Mexican screwworm story. It's really a market that we hadn't talked about, and it's been coming up, getting more expensive in the sale barn. The cattle supplies are very tight, but the combination of the funds being extremely long, then you're getting a story that should send it higher and it's failing. I mean, you're getting warning signs here, and you're also getting the prices where we priced ourselves out of the market. Of course, in the sale barn, that's not necessarily the case for the feeder cattle. A person will pay anything for a feeder cattle. It's just what can you get on the other end? Can you make a profit on it? The numbers already don't work, but you'll often see this in cattle. One of the things I was taught when I first started is, the guy I was working with, he was a former rancher. I did the math. Like, this doesn't work. These guys got a head. It's going to come off any time now. And he pulled me aside. He was kind of chuckling. He had been in the markets many years. And he said, never underestimate a rancher with a checkbook. And I've always remembered that, which the math doesn't have to work, and it doesn't. There's really no way to protect a profit here by buying them up here. But that's still happening, and that's what you'll see at the end of bull markets is just irrational exuberance, and for sure that's what's happening now. I'm not saying there's a huge supply and it's going to get overwhelming, but the natural cycles of the market are when everybody gets tipped to one side. That's when you need to start looking at the hedging side of it. And again, we're looking at hedges that have the upside open and the downside covered, because it is a very strong bull market, very very capable of going much higher. To know where the high is, is impossible, but we're getting to levels where it's starting to make sense. The screw room story is interesting. I don't know how much it has for legs, or if it's just beginning. The story's just beginning, or it's going to end, or if it's a like a hedge fund type story blown out of proportion. You read these statements, and it doesn't really clear anything up on timelines, if anything's going to stop. But the headline makes it seem like that all imports are just banned indefinitely. And I'm not so sure that's the case. You know what it is, about headlines. I believe you have a saying about reading the headlines and trading the headlines.
Well, I mean, I usually say if you trade the headlines, your account has as little money as my account has. But I think the actual saying is something like trade headlines and you'll end up selling newspapers.
Yes, selling papers. So that's another, and there's a lot of commodity sayings. I think we're going to try to do one per podcast. Yeah, and it means, if you read headlines, you're not going to make any money. You're going to have a job actually selling the papers on a paper route. Even though that doesn't happen anymore nowadays. I never had a paper route, did you?
I did not have a paper route, no.
I'd never really wanted one. I like the idea of riding around on my bike, which I did to rummage shelves looking for that very old comic book that was going to basically make my retirement.
Nice.
I did find some old ones, but they usually had pages ripped and scribbles. But no, I never had a paper route. And that's what people like to do. They reacted on the headline. It did not work at all on cattle. Warning sign number one, this thing's getting tired. But we also have holiday trade right now. A lot of people give the holiday trade a bad rap, but I don't mind. I'm not this 1,000-lot trader that needs all this liquidity. I don't mind a little quieter market that you got time to think about things. I actually enjoy the holiday markets. It does get a bad rap. So whether we have holiday market trading, it's really hard to tell. All we know is there's been money winging around these markets like crazy. I'm at cattle market. It's well before this story broke. They were buying the back end of cattle, which makes no sense. So how do I break this down for hedging? On the speculation side, what I'm personally looking for is cattle bear spreads in the back end. And various combinations of that. So, and I'm not going to mention specific months. You can call me and ask what I'm looking at, but I definitely am tracking a certain bull spread in the back end that I plan on bear spreading when I think the time's come. So that's how I'm going to try to pick the cattle top personally. I like spreads that get out of whack, historically, and then when you think it's the top, start putting them on. Now they're much more forgiving because it's not going to have, if cattle moves $2, the spreads, in the back end's probably going to move 20, 30 cents. But
usually, let's just qualify that. Usually,
spreads can be more dangerous than actual positions. So I like to bear spread when I think it's going to be done if it's set up correctly. And there is a very good setup that I am looking at. I'm not running out there and doing that today. I'll probably get through the weekend. We have all these announcements. I was on the couch yesterday watching TV, and then I saw the headlines with the Trump tariffs, and I had forgotten what it's like in the Trump era, and so it brought a smile to my face. It doesn't mean it's going to be easy. So you saw 25% tariffs threatened on Mexico and Canada, and then they're already hashing it out, and we'll see. So we got a lot of that coming up. That'll affect a lot of these markets as well, and it could affect cattle. But it's I kind of forgot. You just have to get in that. You have to recognize what kind of markets that you're in, first of all. In cattle, we're in an older bull market, and that's why I'm looking at hedging. And then you have to, and right now we're in the Trump era. Tweets could change the markets in a second. So I'm personally approaching it on a daily, just take it day by day basis, and trying to use limited risk for my hedges. These aren't markets where you want to stick your neck out, and that's what I'm looking at in cattle. I want to keep it all, to some degree, the risk down. because we're going to go in for Thanksgiving, and you're all of a sudden going to see another headline, and it may be positive for the price, it may be negative. We don't know, but you're going to see a lot of back and forth for the next 8 weeks, or 7 weeks till he's inaugurated.
Well, it might be 4 years and 8 weeks. That's I mean,
yeah, it's going to seem like an eternity every day. But my advice to people is recognize what kind of markets that you're in, and then trade the market accordingly. And these you have to tread very carefully, but let it open up, get a feel for the way that it's trading, and then make your trades or hedges, and then keep the risk really low. And that's the combination I would use while they're talking about all these tariffs, which is going to be all anybody's talking about for the next couple weeks.
Well, yeah. Jumping back on cattle, I just had a follow-up thought on that. So I don't think it was even 2 months ago we were saying it was impossible to hedge cattle because cash was so far over what was on the board.
The board is very poor to use as a hedge, yes.
Yeah. So what has changed? Is it the fund money that has come in? Cash must come down some.
Yeah. Like a light switch, one day they decided they were going to buy cattle. And people think that this is a real thought-out plan, but it isn't. It's pie chart buying, that we need a lot more representation in the meats. And they started buying hogs, they started buying feeder cattle, and they started buying cattle, and they haven't stopped. And I think that, 2 months ago maybe that they started? So they built this very large positions in the meat complex, looking to get more exposure there. That's what they've got. And you got an older bull market here. So now it is a better board to hedge. Last year was much better. I think, if I can remember, November feeders were $14 ahead of cash when it topped out there in September. So it had already topped out and made its low in December. But this year it hasn't. It's kind of been the opposite of last year. And it's going more with the normal seasonals in cattle this year, and February would be the live cattle normal seasonal high. So it is trending with that. So this is why I'm getting ready for the hedges, and this is why I'm planning for the hedges, because it's all set up. But last year we were carrying substantial premiums and anything deferred, and it was really hedgers friendly last August, I would call it, last September, carrying gigantic premiums in feeder cattle. That's not really happening this year. As a matter of fact, January through the spring months are almost all the same price. Highly unusual that it would be structured that way. So the hedging opportunity is better up front than it is in the back end, but still a way better board than it was even 8-9 weeks ago. Much better.
So would you have a real world example of a hedge that worked last year? I mean, being that high over cash?
Yeah, just straight feeder hedges work, like puts. January, March's bought. December live cattle puts worked very good. It depends on the operation you have. You're gonna have guys that just short the futures contract, and they lock that price in, and they lock their profits in. But the best hedges worked were very short-term options in August. So let's just say you bought December live cattle puts in August. You did very well. Like, short-term puts made a lot of money when it topped out, because when it topped out, it came down very fast. So that's what worked really good last year. If you bought a fence, which would mean, or you sold a fence, sold a call, bought a put, that worked. If you just bought a bull put spread, which is what they call it, it means you're buying a higher put, and that in order to cheapen that up, you're selling a lower put. So, for instance, for argument's sake, let's say we bought a 190 live cattle put in December and then sold a 180. You'd have a $10 window where you were protected, but you wouldn't have any protection after 180. So you have this $10 window that you can buy. And why would you do that? If you thought it was going to fall, but not terribly far, and you wanted to protect just a certain window, that worked. But just the straight put was the answer last year, or a straight short. But the puts worked the best because it was hard to know where it was going to top, and when it did, it fell very fast. It wasn't too exciting because it kind of fell out of season last year. But here's the kicker for the guys, LRP versus the guys that had puts. It fell and made its low, I think, in November. Those guys that had bought the puts have the choice of getting out. If you have LRP insurance, you can't get out of that. You just are stuck in the window that you bought it for. So this one particular client was able to get out, take his protection off. Now, he had risk at that point of the market continuing to fall, but he's thought, hey, it's fallen $30. I don't think it's going any lower. Put that money in his pocket, and later was able to market his cattle from near where they fell from. So that worked out. He made money on his hedge, and then he made money back selling his cattle where it came from. I wouldn't say that's what you shoot for every time, but that's what's nice about cattle puts is you have that flexibility to be able to choose when you want to take it off. And I think that works really good for grains too. The old school way of thinking is if you shorted December futures or bought a December put in corn, you just stay the whole time period just for that protection. But you're going to find nowadays with the world demand the way it is that you'll find your lows somewhere in your protection window. Very rarely does the protection end on the best date. So, and another huge advantage of buying that over insurance is you get to choose when to get out and when you don't want to be protected. But that's your choice as a producer. Hey, I hedge this. I don't feel there's any more downside risk. I want to take that off. I call it trading the hedge, but it really isn't. You're just putting it into your own hands. Those guys that do that do much better than the guys that hang on to stuff. It tends to go down and then come back up. That's just the nature of the markets and the way the demand is on these grains, on the cattle. So the grain hedging, which we haven't talked about, is going to be a much tougher hedge going forward because of all the politics involved and all the surprise announcements. We're not going to be able to know if trade deals are going to work out, whether it's going to be a full-blown trade war and what's going to happen, which makes hedging very, very difficult. So again, my advice is the guys in the grains, just take it day by day and try to figure out the best you can. But there's a lot of risk here because it doesn't have to do everything with tariffs and all the rest of it. It's that South American weather. And everything looks really good there. And in 4 weeks from now, that's all anybody's going to be talking about is that South American weather and the potential we have with that crop.
I'm guessing there will still be some tariff talk too, but in
daily.
4 weeks.
That'll be daily. I've had enough of it already and everybody's opinions on it. Everybody's going to have their opinions and it gets very political very quickly. I think you're just going to have to watch the process because I don't think there's any other way to do it. Hopefully it works out beneficial for everybody, but there's no guarantee of that.
Yeah. Speaking of money pouring in, let's talk about the Dow and the financials because we do trade some of these indices too. And
say it, Bitcoin.
Bitcoin, yeah. Talk about pouring money in.
Yeah.
Bitcoin, the Dow has been insane. S&P 500's been insane.
One could say it's excess speculation or speculation gone completely insane. Yeah, you're seeing a lot of big market moves right now, and not every one of them makes sense. And there's a lot of money going into the stock market. There's a lot of money going into commodities, but it really depends on which commodity and with what time frames. We saw a lot of money flow into soybeans in September. That didn't work out for those investors. It's right back to where it started from. Cattle, has caught a lot of money. Bitcoin obviously is just a gigantic amount of money.
I'm just waiting for it to hit 100,000 so I can buy it.
Haven't you heard it's going to 1 million? Yeah, I love how all the beam.
I put a buy stop up at 100K.
Yeah, no, we there's futures on Bitcoin, and we're certainly capable of doing that here. I don't know that you want to, nor do I recommend it, but it's everywhere, whether you want to hear about it or not. My brother's coming home from Thanksgiving. He's a big Bitcoin guy. I'm sure I get to hear about it all weekend long. But, the people that love it, and the other people, that they wish they would have bought it. I'm in that camp, but I would definitely be unloading it. Who knows what this is or where it's going. But that's really driving a lot of things. You create wealth on Bitcoin, money gets spread out over all kinds of different markets. I have a feeling that if the stock market went down and Bitcoin went down, that a lot of this commodity fund buying would dry up very quickly. So it seems all very tied together, but very powerful. I don't know where it's going.
No. Well, two things on the Bitcoin side. I remember being at the golf course and some guy trying to explain Bitcoin to me when it was $10, and I thought, who would put $10 into this thing I don't understand? And at that time, there was no way, like, you had to know how to code something to buy it. I couldn't even follow at that time.
Yeah. Yep. I had something similar, but this was gold when we were in high school. Right after high school, one of my friends named Doug, who I'm not sure you're going to take a lot of financial advice from Doug. Nice guy, but he was selling gold coins, and he said, I think it was $3.96 at the time for per ounce, and he said, "This is it. This is like this." This is a depressed price. He had his whole spiel, and I'm like, this seems like the worst idea ever. It's right up there when I used to live in Vail too. I used to work in this restaurant called Beano's Cabin in Beaver Creek. Anyway, it was a very high-end restaurant, and all the waiters who did very well there, it was a very nice job that was very hard to get. They would pool their money and buy these condos in Vail. They were not the fancy ones, but still very nice. It's Vail. And they were paying $117 per condo, and I thought they were out of their mind. I'm like, boy, are you guys going to take a bath on this one? So my track record with figuring that stuff out is poor to very poor, and I'm there with Bitcoin. I go with the flow. I tire of hearing about it and how it's something that you can't imagine how great it is, and no one can really describe exactly what it is, and they all have a different definition. But we'll let it run its course. It's very powerful.
I'm happy to be proven wrong.
Yeah.
I'd be interested to hear. I do wish I had $1,000 when it was $10 a coin, but I did not do that. So now we'll just watch and see what goes.
Well, it's important because unfortunately it ties into grain and livestock and everything. I don't want it to, but it does. I have a feeling if Bitcoin were to come off, that commodities probably would be tied to it to some degree. And this is insane to say because I don't even think this would have been around 3 years ago, but the markets are getting more consolidated together. Everybody's, it's supposed to run independently, especially in commodities, but that's not what we're seeing. We're seeing wads of money show up and just buy certain sectors of the commodity markets and then leave. Historically, that's not a very good investment, but that's the markets that we're in. And back to you need to just identify the markets that you're in and trade and try to trade it accordingly. This one's changed really quick from what it was even 2 months ago. It started in September. And it's gotten very difficult, but my advice is take it day by day and try to figure out the best hedges that you can.
That's why I'm looking at those meme coins. I saw one called ZapCat. And with a name like ZapCat, how can you go wrong? Doge, look what that did, right? Now it's a whole government organization.
1998 into 1999, they had a lot of these internet companies popping up just like a lot of these coins. And I'm going to guess very few of these internet companies are around, which I'm going to guess is going to happen in the coins. Yeah, my brother wanted me to mint a coin. I don't know how to do it. I think you just type stuff and you have a coin, And
I would think you could use AI.
It feels like it might be a mania. Again, we're only talking about it because it ties so much into commodities and commodity investing. So all this money has just been wadded up and built up and hyped up. And I think it's going to end really poorly for commodities. I could be way off here. Maybe we're just beginning our commodity run higher on hyperinflation or whatever they want to sell you. But I'm going to guess that this natural supply and demand of the commodity markets is ultimately what's going to dictate the price in the end. So that's why I'm interested in cattle and talking about hedging. The grains, they've got me wore out. It's not a time of year where you want to lock this price in, but you have very real risk to the downside right now, and there's not a really easy way to address it. Yeah, you can buy puts, give up some more of the bottom line, but there's very little of the bottom line there. But it's just a high risk environment for grains right now, and I don't know the best route other than to take it day by day, like I've been saying.
Yeah, I think it's funny because we talked all summer, right, where you got to protect the guys who wait. And now we are on the other side. And it's because we are market-based and what we're seeing out there.
Yeah.
Right? but now is the time where you should sit on your hands for the most part. I mean,
Yep.
there's some options. Literally, options is probably your best option.
Yeah.
But there's just not much you can do unless you want to buy like soy oil.
Yeah, last year it was very easy. Like I say, with corn options, I'm looking for that same opportunity this year, and when it comes, I'm going to buy it that day. I want something that locks in a floor for corn for next year's crop, because you're trying to break that cycle. If you're still discussing what to do with this year's crop, you'll have to figure that out. It is what it is, but already you need to be working on 25. And when that price gets there, I want to buy something that gives me the floor, futures floor, and has the upside wide open, because, again, we mentioned this a lot. We don't know where the price is going. So we want the floor bought. We want that upside wide open. And then you can just get out to planting and do what you normally do. And you don't have to worry about it like everybody else. Yes, there's going to be some capital outlay, but there won't be margins in what I'm looking at doing. And I just hope we can get to those levels. And that we're not near them right now. But things change really fast in commodities, and I expect them to. We should see an opportunity. The biggest danger is that we slowly start fading. The funds hate the grains, and they start selling like they did earlier last year, and we don't get that opportunity. And that is nothing anybody can do anything about. But it's a possibility this year just because of the South American weather.
Yeah. Well, and that's another factor there. Let's say all of a sudden there is no trade war and the weather turns bad in South America. That could have the opposite effect.
Yeah.
Right?
Yeah. We talk more on the negative side of stuff now. But it could the trade deals could go wonderfully. It could have the best trade deals ever.
The greatest trade deals that have ever.
The record-breaking trade deals.
Yeah.
We don't know. I mean, and that could go a lot better than people think it could go. And then, again, it take one forecast shift in South America in December going into January to completely change that attitude. And we could be discussing what to do in much higher markets. And that's what I'm hoping, that we get that chance. But for right now, that's not the forecast. But commodities change very, very quickly, and never get locked into one way of thinking, because it'll humble you very, very fast.
It's also why you don't want to market 100% of your, or 90% one way, right? I mean, you want to work your way into whatever you're hedging.
Yeah, I had another. We'll talk about another hedge at work. I have a customer that I brought in the winter. We went over a lot of different things, and he kind of decided to change his philosophy a little bit. He was going to read less newsletters and just focus on what makes money on the farm. And he was able to use the programs at the elevator to get a very nice corn price. He recognized that this would be a good year to take advantage of it, instead of the elevator taking advantage of with the program in a bull year where it's a bad deal. He recognized it as a very good deal. Yeah, certainly the fundamentals could have changed. So he was able to do that. He was able to forward contract some, and then he was able to keep the bushels open, upside open, and then able to market some in the springtime, although it wasn't the price he wanted. So he did 3 or 4 things, and none of the same in like one narrow window. He had just kind of diversified the way he marketed his corn, and he did very, very good this year. And he was happy last time I talked to him. He was able to recognize that this program's really good for me and my farm this year, because he's just been in the markets for so long. And that's where you want to get to. You want to use the programs to your advantage. You want to use this futures account to your advantage. Your storage, know when to use your storage to your advantage, or a combination of all three. Exactly. That's what you want to strive to get to. So it's not all bad stories out there. There's guys that learn from their mistakes. And again, you want to start focusing on December 25 corn instead of waiting till it's too late and then fretting about what you're going to do about it for another year. So that's where my focus is trying to get that locked in. And I don't have a good answer for beans. Beans feel like they're going to be very difficult. I've had a number of guys call me on November 25 beans. What should I do? And we've had a few different ideas, and none of them have been particularly great, because there's very little margins to make money there the way it is, much less spending more money. So soybeans are really hard right now, and there's not a lot you can do after it's fallen 70 cents.
I mentioned it earlier, but what's the deal with soy oil? Because that seems to be the only thing that wants to go green right now.
Yeah, the politics, every choice and every secretary, like that new secretary of agriculture, will swing around soybean oil prices because of the biodiesel and the programs and what may or may not happen, and they speculate on what these people are going to do. So I think it was Brooke Rollins, I think, is who they picked for the Secretary of Ag. So it's been swinging around wildly, more down than up. But I believe, if I'm not mistaken, we're 11 weeks into the export projections, and I think we're 110% of the USDA forecast. So obviously they're gonna raise those exports a lot. Ending stocks are quite low. So soybeans are a more bullish part of the complex without a doubt. But you have so many politics tied to soybean oil. And it's been swinging more negative with the idea that the biodiesel may or may not happen. Now, today, it was up because of the Trump tariff talk. It was like, okay, so if it's going to get tough with China, then that used cooking oil, which is what's depressed the soy oil market, is not going to flow into the U.S. anymore, and that would be very bullish. So that's my problem with soy oil, is that because of politics, it seems to change its attitude every day. But it's actually the one market that does have a bright outlook, at least in the short term.
Sure.
With politics aside.
Well, if that goes up, then we're going to have cheap meal. So then we can just keep feeding cattle cheap and
what we got to figure out.
Up. Is that the way it works?
Well, we have all these
all
these new plants online. I've been asked that a few times. Where's all this meal going from the biodiesel? When they used to crush the bean, you get meal, you get oil. The oil used to be this byproduct that you couldn't give away. And it was the meal that everybody was after, and soy oil was more often than not the short on the meal oil spread. Now it's kind of gone full circle to where oil is what they crush the bean for. Of course, they use meal for the protein, but they have all this meal left over, and the meal price is way down there, and it is the lowest in 3 years, I think.
I know it's way down there. I hadn't even looked today, but.
Yeah, and so what is the future of soy meal? Well, where soy meal goes, soybeans generally trend. So it is very important. But it is just throw it on that pile of feed we have in the U.S. There's excess feed everywhere right now, and soybean meal is no exception. There's a lot of it around.
I guess I should go buy some cows.
Yeah.
I mean, going full circle, I didn't have a paper route, but I did feed a calf every year.
Yeah.
Thanks, 4-H.
Those are the words that are spoken right before you lose a lot of money. I should go buy a bunch of cattle.
We can put them out there and go when we're collecting minnows, and it's my cows staring at us because I can't sell them anymore.
You can you could forward purchase your feed to and write it off for that tax year. There's all kinds of great advantages, but and we even know how to hedge cattle, and I don't think that I could make money in cattle. No, it's joked about a lot, but it's for the people that know those markets, and even when you know those markets, I think it's plenty dangerous to buy cattle. I sure do like to eat it though.
Oh, I love eating a cow.
Yeah, we live
I don't care what part. We
live in a great area where you're able to pick and choose the meat that you want. I have a lot of clients that sell beef, and there's no excuse not to have good beef around here.
Right, and that's why you're going to the world famous Testicle Festival in Clitheroe this weekend.
It's been brought up to me
this weekend.
It's been brought up to me by two different people. One being my wife. Yeah, I don't know why I would go there. I guess you have to see what it's all about. But I think the name says it all.
Yeah,
there's a couple
of those. I have no
of those
desire
around.
To go.
No.
Yeah.
There's one in Dent, and there's one in Clitheroe, I think, coming up this weekend. No, I don't think I'm going to attend this year.
Yeah, I am skipping as well.
I wonder if they stick them in the beer, and then you drink your beer, and then finish it. There must be something other than just eating them.
Yeah, I guess maybe I need to go one year. Find out.
We'll send someone in.
If there's beer.
Oh, there'll be beer in Clitheroe. That's all there is there. I think is there not 3 bars in a town of maybe 15 people?
That at least.
It's surrounded by lakes, and there is quite the population.
At least 3 bars, not at least 15 people, because I think 15 might be a high estimate.
Yes, there's a lot of bars per population in that town. But no, they'll have a good time. I probably won't be there.
Excellent. What else did you want to talk about? Oh, you know what we didn't touch on, what you and I had discussed earlier, was interest rates.
Yeah.
We know how they affect the farm, right? But what's going on with interest rates? We briefly touched on them last week, but
yeah, it goes back to the politics. In front of an election, you're not going to see them heavily raise rates. But what happened is they lowered rates over the last couple of months, and rates have still gone higher. And that's been the talk, is these sticky rates and sticky inflation. The outlook for now is very mixed. When you hear them talk about it, they talk out of both sides of their mouth. They're going to be data driven. The last time they mentioned that they aren't in a quick hurry to continue to lower rates, nor do they see that as necessary. That's because the CPI and the PPI are creeping back up. So you're getting that inflationary feel again, and certainly you're seeing it in commodities as the money's bouncing around, and people are feeling it at home. So you're at this crossroads where rate hikes might be back on the table. The election's over. In December, I think it's down to 25% chance that there's going to be a rate cut. So it's still higher chance for a rate cut. They've been cutting rates, but rates have been going higher. So up is down and down is up now. And they've been moving inverse to what you normally see when the Fed speaks. So I don't think that trend's going to change anytime soon. If the stock market were to come off and start going down, then I think you'd see more rate cut talks. But then you talk to the farming community or eggs in general, and everybody's definitely hoping that rates go lower. But on the future side of stuff, that's something that you can participate in. And the SOFR futures, the SOFR, is basically short-term U.S. rates, and you can pick any time frame in $100,000 increments. So there is a way to hedge your interest rates. Absolutely. That's something for a personal call, and instead of breaking it down right here, but that's something that you don't hear talked a lot about in eggs, but you absolutely, there's markets to hedge your interest rates. Now you can hedge in what you think is a really low rate, and it can get a lot lower. And of course you would lose money on that hedge, just like any other hedge that you have wrong. But there is definitely a way to lock in rates, on paper to some degree. It's not going to be the money that you get from the bank. It's going to be, just like here. I'm not going to physically take your corn, but your corn's hedged here. Same sort of concept. But it's something that guys should learn about, and a lot more. There's been no need to talk about it for the last decade because there hasn't been anything but near 0% interest rates. But in the days ahead, it's going to be very, very important. If you get large swings into lower rates, that you're able to know what to do to lock those in.
So do they make the bond market, did they purposely make it super tricky? Because bonds go up, so rates go down.
Yeah. They
Is
move.
That how it
they
works?
move
And then
inverse.
they move in 30 seconds, right? Or eighths or sixteenths, depending on what.
Every market is different. And then a lot of people don't know the euro dollar, which is now SOFR futures, is one of the only ones when you enter it in like a trading platform, you use a decimal point. So like when you buy corn, you don't buy 420.25. You put 4202, and the 2 represents a quarter. But in SOFR futures, you do use a decimal point. It's one of the only ones, if not the only one, where you use a decimal point in order entry. So they all have their own. That's a whole. We'll talk about interest rates from beginning to end in one episode or a half episode. It's probably too boring to talk the whole episode.
I think we want people to keep listening to the show, so maybe we could do it over 4 episodes.
But it's super, super important to get educated in that too, so you know what you're doing, and when they talk about it, even in the news, you know what direction it might be trending. What makes this one particularly tricky is that, yes, it moves inverse. Bonds go down, rates go up. But they've been lowering short-term rates, and the longer-term rates, and a lot of stuff in between has been going higher. So it's been moving inverse to what the Fed's been doing, which is highly unusual as well. but then the US dollar going up every day and commodity investing going, money pouring in. All this is unusual. That's why it's been very difficult markets for about the last 3 months. Up is down and down is up. And that's just the way stuff is trading.
Can you talk a little bit, because I think it does affect at least a long-term outlook of what that means, what the interest rates currently and what's happening means for the banks?
Yeah, the banks will be using, these futures as hedges on a daily basis. The banks bought bonds, the entire, whatever were yielding 1.2% for a lot of time, 10 years or more. So they have all these bonds on their books that are way underwater, meaning they're worth a lot less than what they bought them for. Now, if the banks hold them to maturity, they will get all their money back. But if you try to sell that bond that you bought, let's just say a 10-year for 1.2%, and the reason why they did that is because they had to get that interest rate, and that was all that was available at the time for many years. So it collected in these portfolios in these banks and these financial firms. So they have all these unrealized losses on their books right now, and that's what made everything shaky last summer. And now the rates are right back up to where those losses are significant again. They're hoping that they can outlast this, keep those losses on the books, and never have to realize them. If they had to realize these losses mark to market right now, all these banks would be wiped out virtually overnight. So that's something that really could set the whole debt bomb off. That's still not gone away. It got a little bit more calm as the rates have come up. But if rates came off, now the rates going back up, if they were to accelerate up, that would set that bomb off. The losses would just be too big, and they would be last summer, a lot of them were insolvent on paper. So you do have to keep your eye on that. There's a lot of bad debt on the books. They bought a lot of cheap yielding stuff, and now it's worth a lot less than what they bought it for. And that's just the way it works. Like you could buy, let's just say for 30-year, you bought 8%, just for easy math, even though it's not there. And then all of a sudden it was 4% a few years from now. That 8% is worth a lot more money than it would be, than the 4% would be. So that's how it works. So these guys are sitting on all this low yield stuff they paid money for. So they're underwater on all that stuff.
In other words, their hedge is way underwater.
Yes.
They bought it to hedge, basically, right? I mean, that's...
You have to generate income off the money. They were not forced into it, but it wasn't wise for them to do it unless they thought rates were going to stay low indefinitely. Now, can they hold that stuff on the books until maturity? If they can, they get all their money back because it meets at par value at zero again in the end. But if the losses become so big and they need to raise capital and start selling that stuff, that would be a bad issue. And that's what we saw last summer when it started getting really shaky in the markets. So that's something to keep an eye on, all this bad, or I'd call it just low yielding bonds that these guys have bought. So now they're obviously purchasing at higher rates, but still there's tons of that stuff because it was down there for 10 years?
Yeah, more.
Yeah, more. And everybody got used to those low rates, and they only got lower, and now things have changed quite a bit on the farm and everywhere else. That will influence marketings. Last year, you were able to hang on to your corn longer because the interest is lower. Now the payments are going to be higher, expenses are higher. The corn might come out of storage a lot earlier because of interest. So that's how all this interest ties into farming and marketing, is that the time frames get shorter to hold stuff. It costs more money. As a matter of fact, I was just talking to a client today that was going to sell some calls against his interest. So this guy, he knows what he's doing. He's not new to hedging, but he was going to try to sell calls and get 6 cents with that would basically pay for his interest on storing the grains. Now, that's not necessarily a hedge I would suggest doing, but that's very different than we've seen in the last 10 years. No one's had to worry about that at all, and now everybody has to worry about that every day. So it does change guys' patterns and influences probably you to market a lot faster than you normally would. The guys with deep pockets that don't have to worry about interest will sit on it as long as they want, but the other guys that don't have that luxury, you'll see them sell quicker on rallies than before.
I mean, it definitely affects lines of credit, and
it affects everything in every business
faster. And I know that like we have some business notes that renew in 5 years, and I keep thinking, when did we take that out? Because I hope 5 years isn't up this year.
Yeah.
And so there's a lot of those things that affect.
Yeah, even equity in your home. You're not, people would take it out with no problem, and you'd have that nice low rate. Now, if you do it, you're going away from your 3% or 3.5% you have locked in, and all of a sudden you're borrowing at 7, 8, 9% or more. It's not a good feeling to refinance your house. You're not refinancing, but you're taking equity on your house on a much higher rate. So it will eventually slow the spending down too. And I think we're just at the tail end of the low interest rate cycle. So expect a lot of volatility, and that's kind of what we're seeing.
Makes sense. Well, John, that's we covered a lot of ground in this episode. You have any closing thoughts?
Yeah, we could have spent a lot of time talking about the tariffs and politics, and it's all speculation, and there's really no hard numbers other than what Trump tweeted out yesterday. But I think if we try to do that all the time, you'll wear yourself out, because he's not even in office. I would pace yourself and just take it day by day. But just looking forward to a broken up weekend or a week with Thanksgiving and some bad football. What is it going to be? Cowboys and some other terrible team. Giants, I think.
Even looked.
Cowboys and Giants, I think. And,
I was hoping there'd be ice to go ice fishing with these single digits overnight. So
I'm sure some crazy people out there. I'm sure on Facebook you're going to see some people on ice they shouldn't be on.
Oh, I'm putting a ladder out and
you're one of those
sliding out
guys.
on my belly and chipping a hole with a screwdriver.
I forgot you were one of those guys. I was making fun of those guys last year, and you didn't have the heart to tell me you are one of those guys.
Yeah, I just thought you were pointing that at me, and I was fine with it, because there's nothing better than needing a ladder to get back across the ice to land.
Yeah, there's a business that just in this area that just gets vehicles, ATVs, a lot of stuff off the bottom of the lake that falls through every year. And last year they were very busy, and I'm sure they will be this year too.
I wish there was some wood on in this office to knock on, but thankfully I haven't had to do that.
There's a lot of stuff on the bottom of the lakes every Minnesota winter.
Hey, the crappies need somewhere to live.
Yeah. It's I'm ready for Thanksgiving.
Me too. I'm ready for some turkey and lefse. We're making lefse.
Yeah, I might be one of the rare ones that actually really likes turkey and looks forward to it. I say that, and everybody looks at me funny.
Yeah. Well, I said I'm looking forward to turkey, but I usually don't take the turkey. I take everything else.
Like the desserts.
Yes, the desserts are the best. So we should have gone around the room and said what we're thankful for, but we'll just save that for Thursday.
That's coming from my mom for sure. She does that one every year.
Does she?
Yep.
You got to think, well, let's not discuss it on the podcast, but I'll help you generate some ideas once we're done recording here. Well, John, I'm thankful for you leaving your phone number if you want to leave that here, and let's wrap it up.
218-731-1578.
Thanks, John.
Yep. Bye.
That's why I'm looking at those meme coins. I saw one called ZapCat. And with a name like ZapCat, how can you go wrong?